Well, ladies and gentlemen, welcome to Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me, as always, is the great deputy editor of Grant, Stephen Lorenz, and Henry French, as per usual, is at the control panel. He's our sound engineer, and we have a guest today, and he is James H.M. Sprayregen, a world-renowned bankruptcy lawyer, vice chairman now of Hilco Global, having spent more than 3 decades in bankruptcy and restructuring practice at Kirkland and Ellis, where he indeed founded their global restructuring department and led such high-profile bankruptcy proceedings as those involving UAL Corp. And Caesars Entertainment Operating Co. Inc. But I say, Jamie, that I have 2 other things to add to your CV. One is that you were a featured speaker at our spring restructuring or distressed investing event. We had that a couple of weeks ago. And second, ladies and gentlemen, is that Jamie Sprayregen starts the day with push-ups, not 100, not 200, no, not 300, not 400, not 500, 600 push-ups. That's one-handed, is it not, Jamie?
2 hands, 2 legs.
2 hands. Yeah. Okay. Well, I just wanted to get that out there because we've had guests that do all sorts of singular, striking things for amusement. But I think, Evan, do you recall anyone who did push-ups as a form of avocation? As like a hobby.
The people who make it through the podcast office, they seem to be a little more on the intellectual side rather than the.
I always say restructure is a contact sport, so you need to be in shape for it.
I would say that in the person and mind of Jamie Sprayregen, we have both the physical and the cerebral. So, Evan, I'm calling in, by the way, ladies and gentlemen. I confess, I am calling in. I'm working from home, a distant home. The truth be told, I am recovering from a hip replacement operation. But still, Evan, we closed an issue of Grants last night, and I must say, it was an outstanding issue. And I invite you, as an employee in this organization, to remind me, because nobody's getting any younger, remind me how great it was.
Fantastic, best ever, bigly.
Well, in what particular respect do you recall it being excellent and indeed unique? Come on.
I actually thought it was a classic Grants issue. It starts off with a front page piece that takes into account what's happening in the markets, including the USA losing its last AAA rating, what it means for money and credit. It goes on to a in-depth look at 2 different stocks that appear to be value laden. It looks at opportunities in the bond market, and it also comments on what's happening in the overall market and the contradictions therein.
Yeah, I'm going to give away one of your lines, Evan, that you wind up your piece on the contradiction of the market. It's a bull market and cognitive dissonance. So it's a bull market in something everywhere, no? I think that's what they say.
Always and everywhere.
Yeah, always and everywhere, correct. There's something else in addition to the legal achievements and the push-up achievements of our guest. I neglected to mention that he is a budding historian. He quoted from an essay co-written by Jamie and a colleague of his, Zachary Manning, a restructuring partner, a professional colleague, not in Hilco. Zach Manning is in the restructuring practices of Kirkland and Ellis in New York. And they wrote a piece on Alexander Hamilton's, basically, Alexander Hamilton's LME, we're calling it here. An LME, as you know, ladies and gentlemen, is a liability management exercise. And I don't know, we at Grants take a rather moralistic view sometimes of these things. And I seem to recall writing that that instead of credit being man's confidence in man, in this day and age of decadent finance, we'll call that provisionally, that an LME rather demands man's confidence in the sagacity of his lawyer, because it is about the ingenuity of the strong and the cunning, when pitted against perhaps the complacency and lack of curiosity about the people who are about to get stuffed. You can be holders of the same security, the same seniority security in a corporate debt structure firm, but still you're likely to wind up very, very much in a lower class because you have been uh, stuffed by people who know their way around the capital structure better, have better legal counsel, and who have done a better job of researching what is available in this day and age of very light or absent covenant restrictions. With all that windy prelude, Jamie, please, I would like to ask you to begin with, you having studied Hamilton's original debt restructuring, what do you make of the talk from the Council of Economic Advisors Office of the possibility someday of a Mar-a-Lago Accord that would involve a slight restructuring and rejiggering of the solemn obligations of the United States Treasury? Is such a thing conceivable? And does Hamilton's own work, formative work, in salvaging the public credit of the United States and building it, does that provide a precedent for what might happen over an investable horizon?
Well, first of all, Jim, thanks for having me. I'm honored to be here and was honored to speak at the Distress Conference. And by the way, full disclosure, the push-ups are every other day, not every day, just to not mislead people. I am a kind of amateur historian. I majored in history in college, as a matter of fact. Uh, And I wrote that liability management in the 1790s article because I'm actually fond of, you've said this many times in your publication, that there may be new things coming along in science and mathematics, but there's really nothing new under the sun in the financial world. And my point was there was an incredibly important liability management exercise of the whole United States um, public debt portfolio right after independence. And it does have a number of parallels to what is happening in the private markets today. It actually was a very successful one, and it put the United States along um, with fiscal union on a path to 250 years with a few ups and downs here and there of growth and prosperity. As to your specific question, I am an amateur historian. I'm not the economist. Uh, Under documents, and if you look at trading prices and where interest rates have gone, is it conceivable and possible you could have an LME? And I know you talked about it with David Nemesek at the end of his LME presentation at the Distress Conference. Yeah, it's possible. I don't think it's going to happen. And I think for the most part, the reason is that would not be a free lunch. It would not be risk free and would have just large, mid, short term, and long term consequences to U.S. government debt. Unfortunately, I think probably an easier way out of it is just to have inflation and have the debt decline in that way, as distinct from a formal liability management exercise.
So after Moody's downgraded the U.S. from AAA, there was an article from Bloomberg over the weekend talking about how the Hong Kong Monetary Authority might have to dump some treasuries because it actually has thresholds of credit risk it can take, and now it's over its skis in terms of U.S. credit risk that is now suddenly lower rated. If the U.S. suddenly moved into selective default, what would it mean for the world?
Well, we talk about risk free treasuries for decades now. I think we'd be talking less about risk free treasuries, and I think it would have tremendous consequences. We all know about the Liz Truss moment on a much smaller economy and a much smaller amount of debt. And I sure hope we don't get there. But I do fear that just like in many of the clients that I've represented over the years in working out their problems, people don't really address their problems, and governments also, until they have to, i.e., until the markets force them to. So I don't know what would happen. There'd be a lot of negative consequences. In an optimistic note, um, our fiscal problems are actually pretty solvable. If you read, various private commentators, they've all come up with solutions that involve some combination of some more revenue and less spending. And given the size of the economy, there are solutions out there. There's not political will at the present time. And one of these days, unfortunately, I think the markets may force the political will on our friends in Washington.
Jamie, in your days, many days in restructuring, you worked with Donald Trump and worked, I guess, the other side of the table with Donald Trump. Tell us about, if you would please, about how the president presented himself as a negotiating adversary. And what did you learn from dealing with him that might be applicable to people trying to handicap the likelihood of the president's success in either negotiating with um, the holdouts in his own political party or with our friends in Russia and the People's Republic of China and Iran? What kind of a negotiator was he? How did you do with him in the transactions with which you were engaged?
Yeah, I had some involvement with him in the casino situations, but I had much deeper and extensive um, involvement in the Conseco bankruptcy case, which was Conseco owned in partnership with Trump what was then called the Trump GM building. Now it's called the GM building. And we got into a little bit of a dispute over our partnership, and it was actually a highly successful investment, and how much of the profits were supposed to go to him and how much were supposed to go to Conseco, and ended up with a big litigation and lots of arbitration, lots of negotiation. Apropos to your question, that we ultimately settled. I would say leopards don't change their spots. He is who he was then, and he is who he is today, and that's the same person. And what I mean by that, I said in my grant speech, from a negotiating standpoint, he's one who is very comfortable with chaos and ambiguity, with uncertainty. And a lot of what we hear today, and probably get to talk about it a little bit more, is the uncertainty that's in the market, for example, because of tariffs. Um, that's not something generally that in my direct negotiating experience with him, which was just over a company, and it did involve billions of dollars, but the grand scheme of things, just tiny compared to what we're talking about in what he's doing today. But in the world of strategy, tactics, and vision, I think it's actually kind of similar. And the negotiations we had with him, not surprisingly, started out with some maximalist demands, with some pretty significant litigation, and ultimately, after a lot of Sturm and Drang, we settled. My simplistic take is based on the facts of the situation, which I won't get into terrible detail on, but that I represented the other side more than we would have liked. And he got about what he expected, which was more than he was entitled to because of those strategy and tactics that he employed. And we wanted to be done. We wanted to get rid of the uncertainty. So ultimately, we settled and resolved it. And I think that informs a lot of what's been going on today. And you hear a lot of people talking about that. And some people might call it some people call it the Besant put, some people call it the Trump put. But what's happened since Liberation Day, which I like to point out was the day after April Fool's Day, uh, it's kind of consistent with what I'm saying, is that there were some maximalist demands, and there's been obviously some backing off of those, and things have calmed down a bit. And to me, that's consistent with the past practice.
Chaos over the GM building is one thing. Chaos involving the world economy is something very different. I'm wondering if it's possible that some of this maximalist business might be of permanent consequence for our markets and for the perception of the stability of the public credit of the United States. Evan, have you checked either the Treasury 20-year Treasury auction today. I'm not sure if it's even got, or the 30-year bond quote. It's a 30-year.
We're talking on Wednesday, May 21st. The auction did not go well, and the bond yields are up, which also means bond prices are down if we're writing as if it were a newspaper.
Yeah, I wondered, Jamie and Evan, this country has flourished for so long on suppressed interest rates. Call it from 2010 to 2000 and first quarter 2022, I guess. But we have been evident in grants in saying that where interest rates have been is almost as important from an investment point of view as where interest rates are going, because where they have been informs the capital structure of so many things that are now vulnerable to persistently high rates that weren't supposed to be persistently high. Right, the call was that the inflation rate would drift benignly back to 2%, and the Fed would follow that, or indeed anticipate that reduction with cuts in the funds rate, and the yield curve would revert to something like normal. And but this has not been the script. So I address this question to you, Jamie. Trillions of dollars in private equity, trillion dollars in private credit, and what do you reckon to be the vulnerability of at least these two departments of American contemporary finance to interest rates that from here do not go down but rather persist in rising? Do you care to venture any hypothesis on where the cracks might come, if indeed cracks are likely to appear?
Yeah, I can make a couple of comments. First of all, given what I do for a living, I'm thinking I'll probably have more to do. That'd be the short summary. I think that I'm a little bit of two minds of your point about consequences of maximalist demands, because on the one hand, I don't think it's a free lunch, and I think um, even though we backed off on the tariffs, we did a lot of damage to what I call our soft power and trust in the consistency of American policy, and ability of American companies and people around the world to plan and doing business with America.
Mm.
Now, on the other hand, you know, people say things will never be the same, and people will never forget this, that, or the other, and the markets do seem to have shorter memories than we would think. So I think this will take a while to play out to see what the overall consequences are on that sort of larger point. On the interest rate point, I actually literally was with a pretty senior hedge fund guy last night talking about this, and I'm always like to make the point, and the financial history better than me, but rates are higher, not really high, in the sense of um, they're much higher than they were when they were zero, or in some places negative. But historically, they're not that high right now, and everybody's waiting for them to go back down to where they say normal was, but how low they were was not normal. And so I don't know where expectations are, both psychologically and how people are looking at the future and further investing. With respect to money that's already in the ground in 29,000 private equity fund portfolio companies that are out there, and many other investments and commitments that have been made based on lower interest rates. Um, the full effect of the higher rates uh, has not been feathered in completely yet. It's been a few years. Obviously, with um, adjustable rate debt, it adjusts right away. But even that doesn't suck up your cash flow immediately such that you have problems. And in fixed rate debt, there's some of it that hasn't reset even as of now. But the clock's ticking on a lot of it. So I like to look at fixed charge coverage ratios, and there's been a persistent and steady decline all in on fixed charge coverage ratios in, kind of across the board. And so when at some point, and I'm not predicting some massive wave of defaults. And I don't know whether ultimately rates will go from higher to less higher, from five-ish to three-ish, pick your numbers. Um, but there are a number of companies out there that um, kind of leveraged up between the great financial crisis and COVID, and then during COVID, with the opportunity for even more leverage, courtesy of the largesse of the federal government and other governments, took on more debt. There's just a lot of companies out there that have unsustainable capital structures unless they're able to grow into them. In many situations, they won't be able to. And I've never been a huge fan of the maturity wall. People look at what the maturities are and they say, look at this big wall coming in the next year or two. And over my 40-year career now, I've actually never seen the wall hit. It always seems to get moved out in sort of mushy, muddy fashion, not in some sequential or exactly clear way. But I'm not saying there's some maturity wall that's going to be hit. It's really when you don't have sufficient liquidity to both service the debt and do what you need to do to run your company, including CapEx. And there's a decent number of situations percolating like that. And they're not all going to go bankrupt and they're not all going to go into restructurings. They may do liability management exercises, or they may come up with structured debt or equity solutions. Sometimes I call it equity. And That's just going to call for a decent amount of activity to, at a minimum, extend the runway, and in a not um, small number of situations where there's probably going to be a redoing of the capital structure, whether in or out of court, and probably a change of ownership, and that'll play out not in some massive fast wave like say we had during COVID, where I say we did a 5-year restructuring cycle in 2.5 quarters, and from March of 20 to Thanksgiving of 20. Here, it's already been kind of elongated, and I think it's got a decent amount to go. Put a huge asterisk on this, and then that all assumes, we don't have sort of tariff chaos or something like that that causes something even bigger.
Is it possible to talk about how healthy is the state of leverage finance today and how it compares to times in the past? And just to throw out a few facts and figures to try to triangulate this, the IMF said that at the end of 2024, 40% of private equity companies had negative free cash flow. If you look at kind of like the typical LBO from 2021, they were levered, 6 times net debt to EBITDA, and that EBITDA was adjusted. So maybe it's 7 or 8 times. But using that 6 times, at the end of 21, SOFR was 5 basis points, so 0.05%. Today, SOFR is 4.33%. If you multiply 4.33 times 6, that means that interest rates are consuming an extra 26% of EBITDA. Um, at the same time, Lincoln International, which is an investment valuation firm based in, I think, Illinois, does a quarterly report on private equity companies. And they found in the last 2 or 3 quarters that the average fixed charge coverage ratio for companies owned by private equity is roughly 1. So how healthy is leverage finance today, and what does it compare to in other periods in the past?
Yeah, those are all very useful statistics, and I think consistent with what I just went through. Um, and Again, there's a sort of on the one hand, on the other hand, quality to the leverage finance market right now, in the sense that all those statistics are concerning, and including what I said in my answer to the previous question would lead you to believe there's going to be some, not small amount of companies that are going to be in need of some sort of restructuring or structuring, and that would include addressing their leverage loans. Having said that, if you just look at the statistics of the leverage finance market right now, it froze up a little bit around Liberation Day for a week or two. But generally, the markets are open. The volume is pretty high. Spreads are pretty tight. This is all, very much a high level summary, but both in high yield and the leverage loan market. And um, if you just woke up and looked at those statistics and hadn't read the newspaper, you wouldn't know there's this whole tariff thing going on out there.
Where is the smart money? I mean, in the past, we'd always think the bond investors were the smart money because bond investors have much more to lose if something goes wrong with the company and they have no upside. They'll get back their principal and interest if things go right. And if I look at the market today, private equity sponsors in general are having trouble getting IPOs of their portfolio companies. You mentioned that there's 29,000, a record high number of portfolio companies in the world today, and the IPO market's roughly shut to them. At the same time, the debt market's open, and these private equity sponsors are doing a lot of dividend recap deals where they raise money or raise debt at the portfolio companies and dividend up cash to their LPs. So it seems like the credit markets are still pretty wide open, but the equity markets aren't exactly accommodating this gigantic surge or this gigantic horde of private equity companies.
Yeah, I mean, there's a lot going on out there. I'm sure there's been a number of strategies employed to handle this, sort of backup in the system and the inability to get liquidity from just a M&A deal on your typical, 5-year-old private equity transaction. So one thing is to do nothing. One thing is to dividend recap. Another thing is to do with liability management, push out maturities. But on a broader basis, there's been uh, the rise of continuation funds, and that's been a way to address some of these issues. The secondaries market in the private equity space is growing by leaps and bounds. There's been the NAV, the net asset value loans on portfolios. These are all manifestations of trying to deal with the 29,000 portfolio companies. So you have all of those things going on all at the same time, not in some organized fashion, but it's sort of the market's response to this kind of situation. As to where's the smart money going, maybe I'll talk my own book here for a moment. At Hilco, we do a lot of things. One of the things we do is asset-based lending in the private credit markets. And I said this at the distress conference. I think that's a good place to think about at the present time because most of private credit these days is cash flow lending. There's a decent amount of it moving into the asset-based lending space. And simplistically, as asset-based lenders, we underwrite these deals on the basis that we can get out even if things go really bad and we have to enforce and either liquidate or sell. And so we make sure we're covered and we're not relying on EBITDA or even adjusted EBITDA or any other kind of fancy um, metrics that have a lot of different definitions. So, I mean, there's a lot of smart money and a lot of smart money going to a lot of smart places. I think that's one place.
One of the private equity has never really dealt with a contraction. AUM has always grown because it's been seen as kind of the best place to put money to work. You get higher returns than the public markets. However, we're seeing university endowments start to actually sell stakes in the secondary market. And their universities are being hit by, first of all, a prospective increase in the endowment tax. They're getting funding cut from the federal government under Trump. But the FT had an article saying that they're selling them not to contribute to the general fund for the university, but they're selling stakes in private equity funds in the secondary market to fund their capital commitments to other private equity funds, which seems a little bit like moving, rearranging deck chairs in the Titanic. Is the lack of inflow of new money into private equity some kind of existential problem for the asset class at the moment, given the backup in companies?
Yeah, existential is a big word.
A bad problem?
It's a problem. How bad a problem, I think, remains to be seen. But everything you mentioned is definitely going on, and these LPs invest on the basis of that there's going to be money coming back over in sort of a semi-steady flow over a reasonable period of time. And if that doesn't happen, and they have all these commitments, the money's going out without the money coming back in. So the things that you're talking about happen in terms of figuring out how to get liquidity. Now, those secondary sales they're talking about, I don't know for sure, but I would imagine aren't at par. So that's got its own consequences. And they're doing what they can to deal with that situation. I would say it also backs up into not just the private equity market, but the private credit market, because a lot of these 29,000 companies have private credit. Not all, obviously, not all of them. And if the private equity fund is not able to uh, get out of their investment, clock ticks on the loans that the private credit guys made, and those may have to be maturities extended, et cetera, which also impacts the private credit fund's ability to get liquidity and give money back to their investors too.
Jamie, no recession is ever convenient. But this would be a most inconvenient time for a serious recession, perhaps triggered by the chaos associated with unpredictable moves in tariffs and the like. You described a kind of a marginal lengthening of maturities and altogether a lack of drama in the resolution of visible debt problems. What would recession do to that scenario? Might it reintroduce the element of high drama into some cyclical problems?
Yeah, I mean, there's the old line from The Great Gatsby of how did you go bankrupt? First gradually and then suddenly. I'm not rooting for that. I'm, rooting for the success of America. Um, but I think you're right. If we did have a recession at this moment in time with everything else going on, um, that could be problematic both in the private markets and the public markets, and could have a serious number of knock-on effects given where we are with both the budget and the deficit.
What industries, Jamie, strike you as most interesting from a restructuring point of view?
I would tell you that in a lot of other cycles I've been through, it was industry specific. Over the years, I've run through restructuring cycles in the automotive supplier sector and automotive in general, and then the aviation sector, the real estate sector, the retail sector. Uh, so far, the last couple of years, it really hasn't been industry specific. It's been more industry agnostic and specific to companies that in a broad array of industries that really have um, uh, capital structure problems and liquidity problems. Having said that, uh, I would say the companies that are particularly dependent, and a number of these are in the retail area, on imports, particularly from China, obviously have a decent amount at risk. I think you also have, this isn't industry specific, but this is size specific. Smaller and medium sized businesses have less ability to deal with this uncertainty, to have pricing power and negotiating power with their suppliers. So I think those are more at risk than a number of the big companies. And this is an incredibly broad category of companies that are impacted by the creative destruction of technological change. And you can't say those are tech companies because today every company's kind of a tech company in one form or another. But you do have that percolating through also. And I'm not any AI expert, and I think it's early days on that, but you're going to have a number of consequences that come out of the AI revolution also on um, how companies are impacted by that. And again, that to me is industry agnostic, not industry specific, although I think AI isn't going to have as big an impact on people who run a bar than who run a business that, the AI can disintermediate the need for a number of their employees.
In terms of the shape of the prospective credit cycle, so in 2009, obviously the banking system almost went under, but it didn't. And the high yield default rate in 2009 actually hit a then all time high, but 12 months later, it actually fell below its long term average. And Marty Fritzen, who's the dean of high yield, came to our conference a decade ago and said, I would tell you that couldn't happen, but it did. And the reason why it did was the Fed took rates down to zero and it flooded the economy with liquidity through its first quantitative easing program. However, the default cycle after the dot-com era actually was a long, drawn-out, multi-year affair that actually led to a relatively high default rate for multiple years. Just given what you see today, do you think the Fed could pull off another hat trick where we'll have a sharp spike in defaults and then it'll quickly peter away? Or just given what you're seeing, the dry tinder on the ground, is this something that's going to be a long, slow burn?
I think, well, by the way, apropos to your Fritzen comment, that's the old economist joke about, well, it works in practice, but what about in theory? And I get the point. I think at a minimum, or maybe best case, and this is what my base case was pre Liberation Day or maybe pre April Fool's Day, was a long, slow burn with a relatively healthy economy, but a swath or some portion of the economy needing services from people like me and others to deal with the fact that they have unsustainable capital structures. The real question that goes to Jim's question on recession and your question on, or you're pointing out what's happened in previous cycles. Just don't know how much worse it's going to get, and it's hard for me to prognosticate. And what's going to happen on tariffs, nobody really knows. I'm not sure, the person making the decision knows at the present time. So it remains to play out. And I made the point at the conference, though, is we do need to be careful of, even with backing off on the worst consequences of the tariff moves. Uh, Sometimes never mind comes takes so long to come that never mind doesn't produce never mind. And there's been, for example, consequences of the exports from China getting shut off for a few weeks before the deal was made. And again, I've used the term free lunch a couple of times here. That wasn't a free lunch, even though it's caused a lot of relief. It takes a while to pack up a whole cargo container in China with everything and then bring it over to the U.S. and then just everybody making their orders and shipping it over and unpacking it and getting it into the store, et cetera. And so even those few weeks of disruption have caused, very big knock-on effect, even with the present, never mind. Clock's ticking on the 90 days. Do people believe it's really 90 days, or is the 90 days going to be extended again, or not, or partially in some form or fashion? So we got all those open questions. Now, uncertainty itself can also cause problems because it causes some paralysis and willingness to invest, and that has its own impact also. And so, again, in the world of, on the one hand, and on the other hand, there still is a lot of investment going on in the U.S., but you do hear a lot of people saying, I don't know what decision to make, and I'm waiting until there's some more clarity. And when there will be more clarity, I can't tell you.
In your work at Kirkland and now at Hilco, you come across a lot of companies and a lot of industries. Aside from restructuring specialist, are you seeing booms in any industries?
I apologize. Booms in
Uh,
what sense?
Booms in activity, like unexpected strength in an industry that's doing very, very well despite all the headwinds you've kind of gone over. Because it does seem like it's a great time to be a restructuring specialist.
It is never boring, and I always say counter-cyclical in the sense of just being here to help. But again, there's been in the retail area, there's been more store closings in the first quarter of 2025 than statistically in a very long time. So I don't know if we call that a boom, but that might be a boom in the sound of not good things happening. Uh, there's been a decent amount of activity in some slices of real estate, obviously office, which is still a slow burn, I think. Some people have called the bottom of that. Some people are way smarter than me. From what we're seeing, anecdotally, and maybe it's just people who come to us, there's a ways to go to deal with those problems. Again, caused by a lot of things, but interest rates in particular. Um, and we've seen, as I mentioned, creative destruction technologically, sort of in the manufacturing space, but again, not particular industries, but that's more broadly general.
Jamie, you've been doing this for a while. Has the moral quality of transactions, the element of equity, of fairness, of trust, man's faith in man, ancient uh, the ancient foundations of credit, have these been chipped away? Have they been confounded or debased in a significant way, or does it always look a little bit corrupt at the top of a cycle?
I think my own view is the latter. Um, the George Bernard Shaw said that a definition of a pessimist is an optimist with experience. And I look at what's going on now, and you're right, I've been a little longer in the tooth than most of the people I deal with these days. And I'm amazed at the number of people I meet that say, wow, this has never happened before. I've never seen this. And I said, well, how long have you been doing this? Like 4 years. So that doesn't, if I go over the broad arc and I go over some of the history I've read over the years, take liability management exercises, for example. There's your point about moral, uh, amoral, immoral, moral turpitude, whatever you want to call it. You do hear a bunch of talk about that. And in the law, there's a phrase, the requirement of good faith and fair dealing. And There's a number of people out there who say these transactions are bad for the market. They corrode trust in the market. I have to admit, I'm one who said, when you signed up for the loan or when you bought the loan on a secondary market, did you read the document? Because for most purposes, and there is some litigation around these things, but for most purposes, what is being done, and people may not like it, and it's in that sense amoral, not immoral or some other thing, but it's amoral. What's being done is mostly what the documents allow and what people signed up for. And there's a number of people who don't like that. What I particularly observe is you have a number of situations where somebody is on the receiving end of a LME that they don't like, and they, cry bloody murder. And then you see that same firm on the giving end of another transaction where this time they're the creditor and the other time they were the equity. And they're saying, well, I'm just doing what the documents allow. So I think there's a lot of noise about it, but no, in the world of there's not that much new or maybe nothing new under the sun. I don't think the morals have particularly changed in doing these things. I will say earlier on in the LME area, there were a number of firms that wouldn't um, do these transactions. And for the most part now, everybody's doing these transactions. And you even have people saying it's their fiduciary duty to do these transactions because if the documents allow it, how can just for morality purposes you not do that which your documents allow you to do to protect your investors' money? And so there's a lot swirling around there, but all in all, I don't think people have really changed.
Well, we have a good friend we do at Grass, a good friend and a good investor. In fact, such a good investor is our friend that he owns a string of racehorses. And the racehorses have romantic interests, and the racehorses breed additional racehorses, and he gets to name them. And one of the horses he's named was called Read the Footnotes. And on that note, ladies and gentlemen, we are going to say goodbye to you and with great reluctance, to Jamie Sprayregen, a good friend of Grant's himself. And I would say
a loyal subscriber, too.
Yes, my goodness. And I don't know, the world may or may not be predatory. It may or may not be corrupt. But I say that within the four walls of Grant's Interest Rate Observer, which include now the person of James H.M. Sprayregen, we are as pure as the driven snow. So, ladies and gentlemen, thank you for listening. Until next time, this is Jim Grant on behalf of Current Yield, Grant's Interest Rate Observer of the Air.